Hi everyone, thank you for joining me in another episode of my Q&A with Wall Street series. In today's episode, I'll be doing Alphabet's Q&A with Wall Street, so let's get right into it. Starting with Brian Nowak from Morgan Stanley asking, how should we think about the potential impact on CapEx and the higher compute intensity of these AI tools to come, potentially impacting margins over the next few years? Long-term efforts on the way to improve efficiency. How should we think about those efforts in 2023 and 2024? So starting with the question, uh, Alphabet has been discussing that it's going to expand its artificial intelligence products, and of course, those take more computing power. And how is that going to impact profits and costs? Is what the analyst wants to know. And also, Alphabet announced job cuts and cost cuts, and Brian wants to know how that's going to play out 2023 and 2024. So the CFO Ruth Porat jumping in to say it's more compute AI is more compute intensive, but it also opens up more services and products for our users, for creators, and for advertisers. So that's going to add to revenue. That's going to increase the top line. So it's also going to increase revenue. And the CFO not really saying if it's going to increase revenue more than it's going to increase costs at this point. That being said, we're very focused on further optimizing the cost of compute, and that's across all elements, data center, servers, and supply chain. So we're continuing to invest with a keen lens on the return on that capital. So that should be reassuring to investors that Alphabet is not just saying, hey, you know what, this is a priority for us. We're going to invest in this area. Doesn't matter how much it's going to cost. No, they're not saying that. They're saying, you know what, it is a priority, but at the same time, we're well aware of the higher costs and decreasing revenue and falling profit margins. And so we're going to take a major focus on the return on the investment. So we're going to focus on high return on investment areas first. Moving on, the CFO says that we noted that we want to be focused and that we are focused on durable improvements in our expense base. So Alphabet is not just interested in making cuts in areas that are temporary, but they wanted to make cost cuts in areas that are the durable, long lasting cost cuts. And in my opinion, they did a solid job in terms of the layoffs they announced because keep in mind they're already implementing a sort of hybrid work structure where you can work from home. Some workers are allowed to work from home, some aren't. Some have to be in the office 3 days a week, some might be 4 days a week. But at the same time, if you reduce your employee count, you also reduce the amount of office space that you need. And so that was something that they highlighted in when they announced their cost cuts is, hey, we're going to reduce our employee count, we're going to reduce hiring, and we're also going to reduce investment in office space. Because yeah, you know what, if we don't have as many employees, we're not going to need as much office space. And oh, by the way, some of our employees are working from home some of the time, so we maybe don't need so much office space. The next question comes from Michael Nathanson of MoffettNathanson asking about the scaling of monetization of YouTube Shorts. What are the sticking points that's causing this to slow ramping up that monetization of YouTube Shorts? So Philip Schindler, Senior VP, Chief Business Officer, chimes in. On the short side, as I said earlier, viewership is growing rapidly. 50 billion plus daily views. This was up from 30 billion last spring. So a 66% increase between that short amount of time. That just goes to highlight how popular short form video is. And now TikTok has been growing in popularity because of this short form video. Facebook and Instagram also highlighted that their short form video program, Reels, is gaining massive popularity. And so across the board, you're seeing consumers increasing the consumption of this short form video format. So, Philip Schindler saying, we're pleased with our continuing progress in monetization, and closing the gap between shorts and long form is a big priority for us. So this can be a massive tailwind for YouTube going forward the next few quarters. Now that they've rolled out this product, now that they've made it widespread and consumers are consuming this product, now they've got to optimize the delivery of advertisements on this format, right? So before this, they had optimized regular short form video advertising, right? Now they got to learn how to do it in this new format. So it's not just like turning on a switch. They've got to work out some kinks before. So when they do that, that's going to unlock a nice potential for revenue and profitability in this format. That's something that Alphabet stock investors should pay attention to going forward. All right, so that's all I've got for this video. Thank you for tuning in. I'll see you next time in my next Q&A with Wall Street session. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.